You made a very provocative comment to me before we had to break away that 2018, at least in the bond market, could be much like 1994, which, in the memory of those who were around at the time, has to be one of the worst they've ever experienced.
Well, what I was saying is that you always have to be a little bit of a contrarian here. And bond prices affect stock prices because stock prices are discounted values of earnings in the future. In 1994, it was a very strong economy. Earnings were up 20%. And it looks like we have a strong economy today. But that also liberates the Fed to sell securities. Quantitative easing can be unwound. Rates can be elevated. And a lot of the people that I talk to believe there are going to be 4 rate hikes instead of 2. We don't try to handicap those things, but we certainly try to protect ourselves against them. And if you do have rates increase enough, that could be reflected in multiples on stocks as well. So you could have both a bad market for bonds and a sideways market for equities, even though there's a lot of actual underlying momentum in corporate earnings and in other macroeconomic realities.
What about the credit market? Stocks, in theory, might have no limit. In the stock market, trees can grow to the sky. In credit, that doesn't happen. Spreads can't go to zero.
They're pretty tight now. I think that people are pretty careless about credit underwriting right now because people are still desperately searching for yield. So we've avoided, like the plague, debt that trades at par. I think the average price of debt in our portfolio is somewhere around 50 cents, plus or minus. Or we like things that are maybe shorter maturity where someone can use the robust bond market to refinance and fix their balance sheet and repair it. We like where there's rapid balance sheet change because then things can change their trading levels.
That's interesting. Where is the locus of this lack of discipline in underwriting?
Well, there have been a lot of flow of cash because there's a lot of liquidity around into 40 Act funds, into mutual funds, into all sorts of different instruments. And when cash flows into an index fund, the index fund essentially has to buy. The same is true with a mutual fund. And many of those types of institutions have a mismatch between their assets, which might be non-investment grade bonds, for example, and their liabilities, which are daily liquidity mutual funds. So if the flows go in the other direction and they have to sell into a less liquid market for that product, you can see prices deteriorate very, very quickly. So we look for that kind of action in the market.
But what about on the origination side? Are banks underwriting crap credits?
Well, I would say they're definitely at the point in the cycle where they're stretching a little bit.
And you see that expressed how?
We see it expressed in the fact that there's a record number of bank loans that have no covenants. We see extraordinary aggressiveness in the interpretation of covenants that exist on bonds, and people get away with it. We see that investors are willing to forego traditional protections in order to get a little extra yield. And that's usually a formula for some downside.
Let's go back to your portfolio for a moment. The average price of the debt securities in the portfolio, 50 cents on the dollar.
Yeah.
So there isn't that much stuff that's trading distressed. B, the stuff that is distressed for a reason. The industries are collapsing, like retail, for example, or those bonds have an awful lot of hair on them.
Some of them are situations that are in the last stages of restructuring where you're ultimately going to be getting ownership in the company. Some of them are higher price but shorter duration. You might buy something at 85 that if they refinance, move the maturities out, give some collateral, everything trades up to par. We also have some securities that came out of distress and have already become equities, but they haven't really become darlings of the mutual fund world yet. And that transition creates a value gap that's quite tangible and quite large.
What's the stupidest place to take risk today?
Oh, that's a good question. That's a hard one for me to say. I'm not sure I can give you a good answer, but I would avoid being in very long duration, low coupon bonds of any sort, particularly investment grade. I just think there's not a lot of upside remaining in high grade, long duration bonds.
Asymmetric relationship between the upside and the downside.
Absolutely.
How do you think things are going to evolve over the next, say, couple of years? If you were to cast your mind forward 12 months, where do you think you'll be deploying capital?
Well, I think right now, over the next, let's say 6 months, it's hard for me to look out an entire year because you don't know what accident's going to happen in the market that's going to create a great buying opportunity. in the debt markets, is these balance sheet repair stories. In the equity markets, there are things like risk arb that have gotten quite interesting. And one of the reasons it's gotten interesting is because antitrust uncertainty is higher than it's probably ever been. So it takes a very long time for a deal to close. And along the way, the stock market has run up so much in a number of situations, like you look at NXPI and Qualcomm, for example, and the SOX index is up over 50% since the deal was announced, yet the deal is at a fixed price. That deal, it's hard to see that closing at that price without a renegotiation on the upside. So the upside downside of some of these transactions has changed a lot because of the market.
Are you doing more of that?
Yes, we are.
For a credit fund?
Yeah, well, we've always been
I
more...
know you've dabbled in other things. Yahoo, for example.
We don't
was a
think
good
of
trade.
it as dabbling, but and we still own Altbaba, and we've gotten that one very right last year, and it looks like it's working out this year. And the tax law, of course, is a big benefit, because you could liquidate the shares and pay a 21% tax, yet the discount inside the corporate structure is more like 27.
So what's the one thing you're in right now that feels most like that Yahoo Alibaba trade?
The Yahoo Alibaba trade. I think there are a number. We like the Time Warner AT&T trade. We're not particularly concerned about the antitrust issues, in the sense that if the antitrust approval doesn't happen, we still like the fundamental value of the stock, particularly in light of what happened in Fox and Disney. I'd say the same I mentioned on Qualcomm and NXPI.